Hagstorm. So stay tuned on this video and give your thumbs to like this video.
Bravely found the book to learn about investment. It is their Warren Buffett Way by Robert G Hagstorm.
My name is Super Corey. I will take you all to the journey about who is Warren Buffett first. Before we talk all about his investment guideline, the writer of this book is Robert G Hagstorm, who was inspired by Warren Buffett and want to help investors employ the strategies that makes Warren Buffett successful. Warren Buffett is one of the richest men in the world. At the time, only one from top 5 richest Americans who made fortune through investment savvy. He was born August 30, 1930, in Omaha, Nebraska. Warren Jr. always fascinated with numbers and could easily do complex mathematical calculations in his head. He attended the business school at the University of Nebraska. While there, he read a book on investing by Benjamin Graham, the professor at Columbia Business School. So he continued studied at Columbia Business School to study directly from Professor Graham's class. After Buffett graduated from Columbia with a master's degree in economics, he invited his former student to join his company, the Graham-Newman Corporation. During his 2-year tenure there, Buffett became fully immersed in his mentor's investment approach. Buffett started his investment partnership with $100. After 13 years, he cashed out with $25 million. At the 2004, when the book is written, his personal net worth was $42.9 billion. The stock in his company is selling at $92.900 per share, and millions of investors around the world hang on his every word. Warren Buffett's approach is uniquely his own, yet it rests on the bedrock of philosophies absorbed from Benjamin Graham, Philip Fisher, John Williams and Charles Munger. They are responsible for Buffett's financial education. The first 3 are educators in the classic sense, and the last is Buffett's partner, alter ego, and pal. All have had a major influence on Buffett's thinking. They have much to offer modern-day investors as well.
Hey, I'm Fantastic Yudi. I will take you to a long journey from first Warren Buffett start the investment and take the lesson learned from the mistake that he has done. Buffett always looks for companies he understands, with consistent earnings history, favorable long-term prospects, showing good return on equity with little debt, and operated by honest and competent people. Importantly, available at attractive prices. This owner-oriented way of looking at potential investments is bedrock to Buffett approach. Buying stocks means buying a business and requires the same discipline. The idea of buying stocks without understanding the companies, the business and operating functions is unconscionable conduct. He makes investment decision based only on how a business operates, understands the revenues, expenses, cash flow, labor relations, pricing flexibility, and capital allocation need. The business have to well understanding in your circle of competence or an area of financial and intellectual understanding. First, Berkshire Hathaway, in addition to its famous stock portfolio, owns many companies directly. Second, when considering new stock purchases, Buffett looks at the underlying business as thoroughly as he would if he were buying the whole company, using a set of basic principles developed over many years. Berkshire Hathaway, an American multinational conglomerate holding company headquartered in Omaha, Nebraska, USA, purchased by Buffett for $8.6 million in March 1967. Warren Buffett began buying stock in Berkshire Hathaway after noticing a pattern in the price direction of its stock whenever the company closed a mill. Eventually, Buffett acknowledged that the textile business was waning and the company's financial situation was not going to improve. But Buffett initially maintained Berkshire's core business of textiles. By 1967, he was expanding into the insurance industry and other investments. Warren Buffett understands the insurance business in a way that few others do. His knowledge about insurance company led to the transformation of Berkshire Hathaway from textile companies into insurance business with the purchase of National Indemnity Company. However, it can be underlined that this applies mostly to people that have a substantial enough amount of capital that can be placed with a view for 5 years or more. Warren Buffett interested in buying into companies that he believes will be successful and profitable for the long term. When a company has demonstrated consistent results with the same type of products year after year, it is reasonable to assume that those results will continue. Buffett avoids purchasing companies that are fundamentally changing direction because their previous plans were unsuccessful. Buffett also tends to avoid businesses that are solving favorable long-term prospects. Buffett suggests to look business that sells a product or a services that are, first, needed or desired. Second, has not close substitute, and third, is not heavily regulated. The combination of the 3 points will give the company price flexibility, which will allow it to earn above average returns on capital. Once again, Buffett makes investment decisions based on how business operates, understands the revenues, expenses, cash flow, labor relations, pricing flexibility, and capital needs. Buffett also avoids businesses that are solving difficult problems. Experience has taught him that turnarounds seldom turn. It can be more profitable to expend energy purchasing good businesses at reasonable prices than difficult businesses at cheaper prices. With his experiences, Buffett initially succeeded investing in Berkshire Hathaway and then followed by Coca-Cola, the Washington Post Company, the McLean Company, the Pampered Chef.
After fantastically explained about investment as a business, just like what Buffett said, it's time for me, Heroic Melty, to talk about management tenets as an investing guideline. Warren Buffett looks very hard at the quality of management when considering a new investment or a business acquisition. The companies or stocks Berkshire purchases must be operated by honest and competent managers whom he can admire and trust. When he finds managers he admires, Buffett is generous with his praise. The highest compliment Buffett can pay a manager is that he or she unfailingly behaves and thinks like an owner of the company. Buffett is just as thorough when it comes to the management of companies whose stock he has under consideration. He looks for 3 traits. First, is the management rational? Second, is the management candid with shareholders? Third, does management resist the institutional imperative? Managers are entrusted with one of the most important business actions, capital allocation. Over a time, capital allocation will determine the shareholder value. With rationality that they have, the management will do everything they got to get any return from capital allocation. The management should be reporting both the mistakes and the achievements in a clear manner so that each investor can understand how the business was run and how it performed. Buffett believes that the institutional imperative is responsible for several serious, but distressingly common. Any business craving of the leader, however foolish, will quickly be supported by detailed rate of return and strategic studies prepared by his troops. Another thing that Buffett mentioned as investing guideline is financial tenets. Relies on 4 financial principles. First, focus on return on equity, not earnings per share. Second, calculate owner earnings to get a true reflection of value. Third, look for companies with high profit margins. Fourth, for every dollar retained has company retained back. Okay, let me explain each of those financial principles. Why we cannot focusing our attention on earning per share but on return on equity. Because it can be easily manipulated by one-time losses or gains. Therefore, earning per share is not an accurate figure to measure the management's performance of creating value. But on the contrary, Buffett believes that business should achieve good returns on equity while employing little or no debt. A company's cash flow is usually calculated as net income after taxes plus depreciation, depletion, amortization and other non-cash charges. However, Buffett saw a flaw in this equation. It doesn't account for capital expenditure, the amount the company uses on new equipment, plant upgrades and other improvement to maintain its economic position and unit volume. The company's net income plus depreciation, depletion and amortization minus capital expenditures and any additional capital needed for the business to keep going. Next principle is profit margins. Buffett looked for profit margins as high as possible, or above average when compared to other competitors. High profit margins suggests that the management is doing a good job at keep costs low or has pricing power or can increase its sales volume without piling up additional costs. Next principle, the increase in value should at least match the amount of retained earnings dollar for dollar. If the value goes up more than retained earnings, so much better. There is no guarantee that through this effort you will fully uncover the truth, but you will have much greater chance of spotting phony numbers than if you do nothing. These are what I could explain to you about investing guideline from Warren Buffett. Next will be explained by Great Shabby.
Thanks Heroic Melty. Hi. I'm Great Shabby and I will continue what Melty has been mentioned regarding investment guideline by Buffett. Theoretically, investors make their decisions based on the differences between price and value. If the price is lower than its per share value, a rational investor will decide to buy. If the price is higher than value, any reasonable investor will pass. As the company moves through its economic life cycle, a savvy investor will periodically reassess the company's value in relation to market price and will buy, sell, or hold share. In sum, then rational investing has 2 components. First, determine the value of the business. Second, buy only when the price is right, when the business is selling at a significant discount to its value. To be a rational investor, we have to determine the value of business. Calculating the current value of a business means we learn about the company's business characteristics, its financial health, and the quality of its managers. And we need to decide what the discount rate should be. Buffett is firm on one point. He looks for companies whose future earnings are as predictable, as certain, as the earnings of bonds. If the company has operated with consistent earnings power and if the business is simple and understandable, Buffett believes he can determine it. Otherwise, if he is unable to project with confidence what the future cash flows of a business will be, he will not attempt to value the company. But focus on business that are understandable will not guarantee investment success. So, how we could determine the price is right? Graham taught Buffett the importance of buying a stock only when the difference between its price and its value represents a margin of safety. Now, let me tell you about the margin of safety principle. First, it protects him from downside price risk. If he calculates that the value of a business is only slightly higher than its per share price, he will not buy the stock, because if the company's intrinsic value were to slightly, eventually the stock price would also drop, perhaps below what he paid for it. The margin of safety also provides opportunities for extraordinary stock returns. If Buffett correctly identifies a company with above-average economic returns, the value of its stock over the long term will steadily march upward. By that, two strategies. Actually, it's simple before you invest on some companies.
Hi guys. Right now it's my turn, Master Yusp, to tell you about Buffett said regarding managing the portfolio. Here are some Buffett commonly used strategies to manage the portfolio. First is active portfolio management. Next, index portfolio management. History said that index portfolio is more outperformed than active portfolio. Okay, let me tell you something about Buffett's opinion about modern portfolio theory, MPT. In MPT, the volatility of the share price defines risk. For Buffett, risk is the possibility of harm. In MPT, the primary benefit of a broadly diversified portfolio is to mitigate the price volatility of the individual stocks. About efficient market theory, Buffett argued that MPT tells you how to be average. If the new thing you are considering to buy is no better than what you know is already available, then it has not met your limit. If that company is bad or has lower class economic for a long time, hold it longer because selling it will be the last step you take. To be successful on managing your portfolio, you have to be the real investor who has these three characteristics.
Thank you for keep watching this video. Hope it will help you to learn about investment.
Thank you for watching.